Hello, everybody. Hi, everyone. The word on everyone's lips today, dividends, baby. Dividends. This is what we are talking about today, guys. We are talking about the Satrix Divi. Now, for those of you who haven't heard about dividends before or aren't sure what that means exactly, a dividend is basically a piece of the profit that a company you're invested in pays out to its shareholders, just for being shareholders. Like, that's cash money right there. Hello. So today we're talking about a dividend paying ETF called the Satrix Divi. And of course, I cannot do these things on my own. I need to bring in the heavyweights. I need to bring in the people. So joining me today, I'll start with Kingsley Williams, who's the Chief Investment Officer at Satrix. Super smart guy. He's been involved with research, portfolio management. Basically, guys, he knows his stuff and he can show you graphs like a boss, which we're going to do just now. And then I also really want to welcome Amy and Lebo. They are a finance duo that has so much fabulousness and fierceness that I had to invite them to this webinar. They work with me at EasyEquities, and when we're talking about cash money, who better than to talk about it than people in finance, right? So you're going to meet them just now. So yes, today we are talking Satrix Divi. I think let's actually just start talking a little bit about dividends and ETFs and TFSAs in general. I know this is something that comes up a lot. So when you think of ETFs, you may think about a tax-free savings account. And we've actually had so many people ask us to unpack what a tax-free savings account is. So I'm going to start off with that. I'm going to give you guys a brief summary of what a tax-free savings account is. It's exactly what it sounds like. It's a way to invest without paying tax. So every year you are able to contribute 36,000 Rand towards your tax-free savings account. And in that tax-free savings account, you can then go and invest that money in things like ETFs, which is what we are talking about today. So you put money into your tax-free savings account, which is something you get automatically when you open an EasyEquities account, up to 36,000 Rand a year, and you can then invest that money in ETFs. Now, why is this the coolest thing since sliced bread? Well, like I said, who wants to pay tax, right? When you invest in an ETF, in a tax-free savings account, you don't pay any capital gains tax, which means that's how much your investment has grown. You don't pay any tax on dividends. Hello, that's what we're talking about today, or the interest that you earn in that account. So that's really a tax-free savings account in a nutshell. And now I want to invite Amy and Lebo. I want to hear from you guys. Do you have tax-free savings accounts? Are you using a tax-free savings accounts? What's the vibe? Amy, you tell us first.
Hi, yes. So I do have a tax-free savings account, and I am invested in ETFs. It's exciting stuff. I've got quite a few ETFs as well, like the Satrix, NASDAQ, Satrix Divi, Satrix Top 40. It's something that I was really interested in and intrigued about. And then when you gave us the opportunity to be a part of this webinar, I definitely went and did my research and furthered it into the ETFs. And yeah, so I do.
How about you, Libs? Are you using your tax-free savings account?
I am. I mean, if I have to not pay any taxes on it and I get that threshold of 36,000, and you saying all the dividends that I get in, all the profits that I make, I don't have to pay tax on it, then of course I'm in it. I want all the money and not pay all the tax. So yeah, I'm using my tax-free account and I try to max it out before tax year ends. So yeah, definitely using tax-free account, and I love ETFs. So yeah, that's how I'm using the tax-free account.
Yeah, that's always the goal, to use our full 36,000 Rand every year. Now, I jumped in with a question, but I forgot that you guys have like fans that you've been talking to about the Satrix Divi all week. So I'm giving you the opportunity to say hi to your fan base, because I know they're probably watching today and they want a shout out.
Hi guys!
Hi guys, we're here!
So talk to me a little bit more about your own personal journeys and investing, guys. Lebo, when did you first start investing, and what was the first thing that you invested in?
All right. So I've always been interested in investing because I mean when you hear about all these rich people, you hear that they have stocks and this and that, and you're just like, that means I need to get myself in buying stocks in order to get rich. But you're just like, how do I do it? Because I mean, do I have to have thousands of rands? And you just don't know how to get about it. So lucky me, I got a job at Purple Group, and I didn't even know about EasyEquities Purple Group. I got a job here, and then here's this fantastic product where they're saying, actually, you can invest. You don't need 100,000 rand, but this was 5 rand. You can invest in shares. I was like, what do you mean? You know? And then I was like, okay. Then we had the demo account. I was playing around with it. I saw that actually, with my little 5 rand, I'm making a profit because I can even buy like fractional shares. And then, so my first investment, I think was in 2016 when Dis-Chem had the IPO. Because one of the advice I got was, because I wanted to know, where must I invest in? Where must I invest in? And then people were saying, invest in the companies that you know, wherever you spend your money on, maybe start there. And then Dis-Chem had the IPO in 2016. And I was like, I'm always at Dis-Chem, so I'm just going to invest there because I'm always at Dis-Chem. And that was the beginning of my investment journey. And then obviously the tax-free account, I got to hear about it then. When it was still like 33,000, I was just loving seeing like the growth, my account in green, going on red, and I'm panicking. But if you know your goals, long-term investments, know not to panic. So yeah, that's how I started my investment journey. It's been a good
one. You know what? I love what you were just saying about the brands that you know and you love. And what I think is really cool about investing in ETFs specifically is that you get a bunch of those that you can invest in as one thing. So for those of you who have never invested in an exchange traded fund before, or as we'll refer to it, an ETF, essentially it is a collection of different companies or different shares that you can invest in with one transaction. And they're created based on different themes. So today we're talking about the Divi. And the Divi is essentially a collection of companies that pay dividends regularly. But we're going to get into that a bit more with Kingsley because he needs to unpack this for us, guys. Amy, maybe you can just tell me, what was your first ETF, or what about ETFs made you want to invest in them?
So my first ETF was actually Satrix Divi, and the reason why was because I did my research and I realized that the Satrix Divi consists of companies that are mature companies, meaning that they are going to do cash payouts rather than taking those funds and reinvesting those funds for growth in their company. So I was like, okay, cool. So I know I'm definitely going to get passive income from this. I'm definitely going to earn something from Satrix Divi, and then it led to Satrix Nasdaq and then Signia. So it was just like unfolding one ETF after the next ETF.
Yeah, and I think that speaks to your strategy, and everyone's got a different strategy, so a lot of people are wanting that little bit of passive income every month. And so a dividend strategy is one that really works for them. You might get other people that think, no, I don't need a dividend payout every month. I just want to, everything to go towards my investments. And that works for them. So I think Kingsley, maybe you can jump in here. What kind of person would be best suited to a dividend paying ETF like the Satrix Divi?
Hi, Carly. Thanks. Good to be with you and Amy and Lebo. Yeah, I think, investors that are typically looking for a yield and a payout would be relying on that as, to either be their income, perhaps when they reach retirement, or maybe they're saving for a goal in the future that is going to require regular payments. So this is where, Divi type strategy, which has that regular payout, would have an obvious role to play. But Niku, in his first presentation, made a very important point that over the long term, one of your biggest contributors to your total investment performance or your total return that you're going to enjoy comes from reinvesting those dividends that you get from your investments back into the underlying investment. So that is probably one of the best things you can do, particularly when you're early on in your savings journey is to plow those dividends back into your investments, because then you get what they call the eighth wonder of the world, that miracle of compounding, of reinvesting back into assets that grow through time, and it creates returns on returns. So I think that's a particularly powerful feature of a dividend strategy, is to be able to reinvest back into it so that you get that compounding effect, and then really build out that savings or that capital base that you have to then use at a later point in time.
I think Warren Buffett does that, doesn't he? It's part of his investment strategy. He's got a few real golden nuggets of not advice, but some tips for investors. And one of his tips is take those dividends and just reinvest them and make your money work even harder for you. So you mentioned something called dividend yields. I have no idea what that is. So tell me, what is dividend yield? What does that mean for investors?
So I'm in two minds as to whether to show a formula, because I think when people see formulas, they just want to run for the hills and say, I don't want to see maths. So maybe let's just talk about it conceptually, and then I'll show the formula to make it a bit real. So, if you were to invest in a property, or maybe let's make it even simpler, invest your money into a bank account, or just deposit your money in a bank account and leave it there. You can think of the yield. The yield would be the interest rate that you would get on that deposit with a bank account. So a dividend yield is very similar. It's just the amount that gets paid out to you on your underlying investment. So let's make another real world example of a property where, say you invested in a property and you rented that out to someone. The yield on that property would be the rental yield that you would receive relative to the price that you'd paid for that property. So say your property's worth, I don't know, 500,000 Rand, and you get 50,000 Rand in rental income on that property over the course of a year, then your yield. I was
going to say, if that's per month, I need to know where this house is, because I'll buy it.
Exactly. Then, and that's the important thing. You need to measure this over a standard period. So it's typically over a year. So if that was 50,000 over the course of a year, it would obviously be whatever that is, 4,000 whatever per month. That would then be your dividend yield would be 10%. 50,000 divided by the cost of that property, or the value of that property. So that would be a 10% yield. And then obviously you'd have other costs and things to take off. So maybe your yield would go down. You'd have to pay your levies and your municipal rates and taxes to the council, etc. So, but that's very, in a nutshell, what dividend yield is. So let me just show you what that looks like when it comes to an investment strategy.
Show us the numbers.
Yeah, so this would just be to basically elaborate what I've just spoken to. So dividend yield is really how much you're receiving in dividends on your particular investment, divided by the price of those investments. So that very simply is your yield. And you can apply this concept to all sorts of things. So whether it's money that you've got in your bank account, how much you receive in interest over the course of a year, divided by what your bank balance is, that would be the yield on that investment. And similarly, like the example I gave you on a property, whatever that property is currently worth, or what you think you'd be able to sell it for, that would be the price in the denominator here. And the amount of income you receive over the course of a year would be the numerator, and that you can then work out what your rental yield is. Now, how the Divi strategy, the ETF works, is it makes one slight change, and the index that we track is called the FTSE JSE Dividend Plus Index. Our ETF is called the Satrix Divi, but it's tracking that Dividend Plus Index. And the reason it's called the Dividend Plus strategy is because it actually doesn't look at historical dividend yields, i.e. what you've earned over the previous 12 months. It's looking at which companies are going to pay the highest dividend yield. So now that we understand what dividend yield is, the way the strategy works is it actually looks on a forward-looking basis based on all the smart analysts that evaluate all the companies on a JSE, takes a consensus view amongst those analysts who rate all those companies and says which of these companies are going to pay the highest dividend yield over the next 12 months. And it selects and weights the companies according to that.
Okay, wait, let me see if I understand this right. So the Satrix Divi ETF follows an index, and an index is really just a measurement. It's the name for a group of different companies. That group of different companies is in that index because they are the companies that we anticipate are going to be paying the highest dividend in the future. Essentially, that's what it is.
Exactly.
Got it.
Yeah.
Okay, cool. So what are some of those companies? I want to know. And how many are there? Are there like millions? Are there a few? What does that look like?
So the index is limited to 30 companies, and it chooses those companies from a subset of the entire market. It excludes your listed property stocks because those typically have very high yields associated with them. As per the example I gave you with renting out your house, you would typically have a much higher yield with those property stocks. So it's looking just at equities, pure equities, not any listed property counters. And it limits it to the large and mid-cap stocks. So it includes the top 40 that Niku spoke about in your first webinar, as well as the mid-cap stocks, which are the medium cap or medium-sized companies on the JSE. So there are about 80 odd or 70 to 80 odd companies that it considers, and it will choose the 30 top paying dividend companies or expected companies that are anticipated to pay the highest dividends relative to their price, the ones that have the highest dividend yield over the next year. So it's going to include those in the index and weight them as well according to the companies that have the highest yield. So if I show you what that looks like, an example of what the index currently looks like, I'll just share that quickly again.
Amy and Lebo, can you guess a company that's in the Satrix Divi? I want to see.
Exaro. I know Exaro is in there. I know it's one of the number one company there. And I know they recently paid a good dividend. So
nice. Amy, give us your guess. Okay, no, you busted. You were right, Livs. Nice.
I was robbed. So you were robbed. Yeah. You're exactly right. I mean, Exaro is the highest weighted company in the index. And you can see, so just to explain this table, this column here actually refers to the current dividend yield, i.e. backwards looking. The next two columns just show you what the weight is in the Dividend Plus index, which you can see that's the highest weighted company. And then for interest sake, I've also just put what the weight of that company is on a market cap weighted basis. So remember from Niku's webinar, he explained what market cap weighting is, which is just weighting the companies based on their size on the JSE. So you can see that this Exaro has not like a really large company. It's like 0.5% in the large and mid cap index, but within the Divi Plus, it's got a weight of almost 9%. So, and that's because it's got this high yield. But the interesting thing when you look at this table is that a company like MTN has got a 0 dividend yield. So what is it doing in a dividend, in a Divi strategy? And this again talks to that subtlety that the Divi Plus is looking at expected dividend yields, not what has happened in the last 12 months. And a lot of companies actually suspended dividends last year, given the COVID-19 outbreak and the lockdowns and the uncertainty associated with that. They wanted to preserve their balance sheets, preserve capital to ensure that the companies were able to weather the storm. So they didn't pay out dividends, and MTN was one such company that didn't pay out dividends last year. But it is still expected to pay out good dividends over the next 12 months. And that's why it has a fairly meaningful weight in this Divi ETF.
So Kingsley, essentially it goes, whoever's got the biggest, whoever is prepared to pay the most dividends gets the biggest piece of the pie in this ETF.
Exactly.
Okay, great. And you spoke about last year, some companies not being able to pay dividends. So will the constituents or what's inside this ETF, will they change based on whether the company sort of changes its strategy? I mean, I know you said it's future, so it's what we predict, the companies we predict are going to pay, but would that change at all based on those?
Yeah, so companies are obviously going through cycles of being more profitable and less profitable, being in a position to distribute more of their earnings and their cash reserves to shareholders, and sometimes less. So dividends on companies are constantly changing, and the expectations of those dividends are constantly changing. So yes, the index rebalances twice a year, and it will look at which companies at that point are expected to pay the highest dividends over the next 12 months, and then structure the index, which our fund then tracks accordingly.
Okay, great.
Companies will get selected, others will get dropped based on those changing expectations.
So Amy, I want to hear, you've had the Satrix Divi for a while. How's that been working for you? Because I want to hear from Kingsley on sort of how it's performed over the last while, but I want to hear, has it been working for you in your portfolio?
Yes, Carly, it has been working for me in my portfolio. There are days when you open the app and you look at it and it's green and you're happy and excited. There's days when it's red and you're like, oh no, is it time for me to pull out now? Should I sell my shares or not? But over the last month or so, I've seen it increase, decrease. And like Lebo said previously, it's for the long run. So you have to keep it in there and you just have to see it grow over time.
Can I also say something, Carly? Sorry. I was just having a chat with Greg, one of our colleagues, and then so I was telling him that we're going to be talking about the Satrix Divi, and so his concern was, but it's been declining. And I'm like, but you need to remember what the strategy is for the Satrix Divi. It's not about you looking at it as the price going up, or is it going down? At the end of the day, you want that dividend. And I know it pays out like a guaranteed dividend every quarter. So you will be getting the base dividend at every quarter. Kingsley, I hope I'm correct by saying that.
No, you're absolutely right, Lebo. So I want to actually show you that yield through time, and just show you how that yield difference works relative to something like the top 40, for example. So let me just again share that with you. So what I'm plotting here is not the performance of the fund itself. I'll come to that in a moment, because I know Carly wants to have a look at that. But this is just the yield through time. So we've explained what dividend yield is and what interest yield and rental yield are. So this is just what that yield has been through time. So this is the yield for the Dividend Plus Index, which our fund tracks. And you can see that this dotted line here is the average. So it's averaging just short of 5%. That's the, of your total investment, the index is paying out close to 5% of its value on an annual basis. At the moment, though, on a 12-month basis, it's actually sitting higher than that, at closer to 6.4%. So this is how it oscillates through time. But I guess this is fairly meaningless unless you look at it relative to what other things are paying from a yield perspective. But I think what's useful to remember here, and this is a very important point about investing in a dividend yield type strategy and having exposure to equity markets, is that not only are you getting that 6.4% yield, you're also getting the capital growth of the underlying equities within the strategy. So this is quite different from putting your money on deposit at a bank, where they might offer you 4% or 5%, or if you stick it in a long-term fixed deposit, maybe you'll get a bit more. But you're not going to get any capital growth on that, because the underlying is just the cash. And if you're drawing that cash out, you're going to get no capital growth. If you reinvest it back in, then you'll get a little bit of growth, but only 6 point, whatever yield they're offering you. The Divi Plus strategy gives you this yield in addition to the capital growth of those equity shares underneath them. So that's a very important point to remember. But have a look at it relative to the top 40. So this is the top 40 dividend yield through time. and it's sort of oscillating around just short of 3%. So the difference between the two is the red line here, which will, you know, on average giving you close to 2% of extra yield per annum versus what you'd get from, say, the top 40 index. But at the moment, it's closer to, you know, just over 3%. So that's the additional yield that you're getting on your investment relative to the broad market. And I think it's part of realizing what a strategy like this can deliver through time. So to come to Carly's point around how it's performed, I showed you a cumulative chart like this when we were talking about MSCI World last week. So I've done the exact same thing now, comparing the FTSE JSE Top 40, which is what our Satrix 40 ETF is based on. So this is how the Satrix 40 has performed through time. So, you know, if this was 100 Rand that you invested back in 2002, it's now grown to over 800. Well, it's sitting probably, this is a log chart, so probably closer to 1,000 Rand. That's how it's grown through time. But if you have a look at the Dividend Plus, it's grown even more. And in fact, if you work out what the average total return is, so this is assuming that you reinvest all those dividends back into the strategy, the top 40 has grown by 13.2% on average per year. Obviously, there are periods where you might have a negative return and there are periods where you'll do better than that. But on average, over this period of time, it's grown by 13.2% per annum. And the Divi Plus has grown by 15.5% per annum over that same period of time. So what's the difference? It's about 2.3% per annum, which is what I've shown in this gray shaded area here. And again, you can see that there'll be times where the Divi Plus may underperform the top 40, like here, that it outperformed, and then it lost a lot of that value to the point that they were both back at the same level again. But then it appreciated again and outperformed again. So it does go through cycles where it outperforms and underperforms what the top 40 is doing. But over the long term, it's managed to deliver 2.3% of excess return per annum versus what the top 40 has done. And that number is very similar. It's about 80% of the additional dividend yield that you're getting. Remember, we said it's about just short of 2% that you're getting of additional yield from the Divi Plus strategy. And that really talks to the power of reinvesting dividends. If you're getting higher dividends and you reinvest that back into the equity market, back into this Divi Plus strategy, it can really compound up and give you that higher return through time. Really talks to the power of being able to get the benefit of that compounding by reinvesting those dividends back into your underlying equity strategy.
Thanks, Kingsley. Do you think, I'm just wondering, is the fact that the Divi has got some mid caps in it as well, does that have any impact when you compare it to the top 40, which obviously has your larger, more established companies in it?
Certainly, yeah. So what explains that additional 2%? And I put it down to two things. One is the higher yield that you're getting, and part of that able to pay out a higher dividend yield relative to their share.
Okay, well, I'm going to pick up there, Kingsley. I'm gonna cut you off there for a minute because we've got some questions coming in, guys. Okay, I've got some questions that were actually sent to us ahead of this webinar, so I think a lot of them we've already covered, but I'm going to jump into a couple that we haven't touched on yet. Okay, so what is better, to invest in an ETF with only a few companies in it? So for example, this ETF has only got 30, or to go for an ETF that has a lot more in it. So something like the MSCI World's got like over 1,000. What is the best way to decide which one to go for, or is there no right or wrong?
So the question is which strategy to invest in, and how diversified to be. So obviously these are offering very, very different strategies. The Divi Plus is local only, so it's more focused on the local market. And as we touched on last week, the key risk that you face when investing offshore is that you're taking that currency risk in addition to what the equity markets are doing. So, that's just a risk you need to be aware of. It can work in your favor to the extent that the rand may weaken. You're going to get an extra boost to your offshore investment. But if the rand strengthens, that's going to create a drag on your performance. And, we've been through a period over the last 12 months where the rand has strengthened significantly from where it was in March last year. So that obviously creates a drag on your offshore performance. So I would recommend starting local, get familiar with companies that you know and that you see and interact with on a daily basis, and without taking that currency risk. And once you're comfortable with investing and the principles around it, then start venturing offshore and expanding your investment portfolio to include other markets, offshore markets, and companies that are a bit further from home.
Cool, I like that strategy. Okay, the next question we have is, how often does the Satrix Divi pay dividends? I think Leb, you actually mentioned something about that earlier, but just to confirm, Kingsley, how often do those actually get paid out?
So the ETF distributes on a quarterly basis. So whatever dividends have accumulated up in the fund over that quarterly period, those get distributed out to end investors on a quarterly basis.
And then someone can decide, do I want to take this cash or do I want to reinvest it, like you said earlier?
Exactly.
This is an interesting question about tax-free savings accounts. The question is, why should I have a tax-free savings account when I can just keep my money in the bank and get a 3% interest on the money that I leave in my bank account? What is the benefit of having a tax-free savings account? So I'm actually going to see if one of our finance gurus wants to jump in there and give me their thoughts. What do you guys think?
Well, Fadi, as you said before, with a tax-free savings account, there's no tax on dividends, there's no tax on capital gains, there's no tax on interest. So that makes it just so much more approachable, applicable, more keen to the investor that, these are the things that you don't need to pay for. These are not your concerns. These are not your worries. And it's also just nice to have a safety net of money kept on the side, with regards to a tax-free savings account.
Yeah, and I think also with the tax-free savings account, instead of your money just sitting in the bank and earning interest, you have the option to invest in ETFs in your tax-free account, and I think that is chef's
Yeah, I think we just saw on the graph what the potential is when you actually invest your money as opposed to saving your money, because there's two different strategies there. I think investing your money, no matter where you invest it, that is a long-term wealth creation strategy. Whereas saving, in my mind, is something you do I'm saving for a pair of roller skates. Well, that's in my case, I'm saving for a pair of roller skates, or I'm saving for a holiday. It's more short-term. And so you don't really want to be taking too much risk. You're happy with the 3% interest because you're saving for something you want to get in the next few months. Whereas investing is, I want to retire like a baller. I need to put some skin in the game and I need to let the markets do all the heavy lifting for me. So that would be a big difference as well. So another question we have is the Satrix, should I look at the Satrix Divi for my tax-free savings account, or should I have it in my ZAR account? Is there a difference as to where I invest it? And what would that difference be? So I think just answering it from my point of view, obviously you get the tax benefits if you invest in your tax-free savings account. But Kingsley, I don't know if there's any other aspects that you need to think about in terms of that.
Yeah, I just wanted to pick up on the conversation around why it makes sense to do a tax-free saving, particularly on a Divi Plus strategy within your tax-free savings account. So those yields that I was showing you on the charts earlier, let's say the average is 5%. If it's not in a tax-free savings account, so that yield is before tax. So if it's not in a tax-free savings account, the dividend withholding tax, or the tax on dividends, is 20%. So that's going to take 1% of that 5% away, and then you're only going to be left with a 4% yield. Whereas if it's in a tax-free savings account, you're going to get that full 5% yield. So that's the reason you want to keep it tax-free. And maximize your tax-free investments. Also, tax-free investments are designed to be long-term wealth-generating vehicles. So, you only get a certain limit to contribute that remains tax-free, and you get a lifetime limit to contribute into that vehicle. So you ideally don't want to be taking that money out and using it, because you never get the opportunity to put it back in. Once it's utilized, it's you've utilized it. Once it's put in, you can and you take it out, you can't put it back in again. So you really want to be compounding up that and getting the maximum benefit from that tax holiday that gets offered within a tax-free savings account.
Yeah, that makes sense. And this making me think about our next question, which is around, is the Satrix Divi a good option for pensioners? And I think this person was referring to being able to get passive income every month and to draw a bit of income every month, which in my mind, based on what you've just said, maybe that's when it is right to have the Satrix Divi in your ZAR account or just your normal account, because if you're going to be withdrawing out of that account, you don't really want to be doing that in your tax-free savings account, right? No,
I mean, I think once you reach the stage where you're drawing a pension, you're going to have an annuity vehicle set up, a living annuity set up to pay you that regular income. But the dividend plus strategy would be a great underpin to help you draw on that capital base that you've built up over your working life, pay out a decent yield while still growing the capital base, because remember, it's invested in equities which over the long term do grow. So that's really the great thing. Whereas if you were just drawing that income out of a cash deposit in a bank, for example, you'd be taking all that income and your capital base wouldn't then grow at all. And that actually means you're going backwards relative to inflation. Whereas at least with the equities, they can continue to grow and outperform inflation, hopefully over the long term, and means that you keep pace with the cost of living while still being able to draw that quite reasonable income from that investment.
Yeah, that's a good point. Okay, I have one last question before I address that question. Amy and Lebo, is there anything from you guys? You've got access to this Satrix Genius right now. So if there's anything you want to pick his brain with from your community or yourselves, now's the time.
I think he answered the question, because I was always wondering, why would one choose the Satrix Divi instead of the Satrix 40? Because I mean, they kind of have like the same companies, but with the demonstration with the graph, I got to see why, because of the yield, and yeah, so I'm happy with that. Yeah.
Okay, good. All right, well then our last question, and you guys might even be able to help with this as well, being on our finance team. The question is, can I transfer my tax-free savings account from another provider to EasyEquities? Do I have to sell everything out of my tax-free savings account in order to do that? So I'm not sure if you guys deal with those kind of things, if that's a question that you can answer. I mean, you absolutely can transfer your TFSA.
Yes, you can transfer your TFSA from another institution to EasyEquities TFSA. You just need permission and
be mindful of that 36,000
limit.
Limit.
Restriction.
So make sure that if you're transferring, you don't already have like a 36,000 in your EasyEquity for that year, because then you'll be taxed on that. So remember
that's a very good point.
Yeah.
Very good point. See, that's why I invited you guys, because you know this stuff. Yes, so if you are interested in transferring your tax-free savings account, it's 100% possible. There's a whole team that handles that kind of thing, and I'll make sure I drop the link in the description of this video. So that's it from us, guys. Thank you so much for joining our chat on the Satrix Divi and on dividends and on ETFs and on TFSAs. Remember, if you have any follow-up questions, you just drop them in the comments below this video and we'll get them to you as soon as we see them. Thank you, everyone. Thanks, Amanda. Thanks, Amy and Lebo. Thanks, Kinsey. You guys are awesome.
Thanks, Kinsey. Thanks, Kylie. Bye.
Bye.